At exactly 11:59 p.m. in Washington, a sentence appears on a government website. Markets freeze, anchors hold their breath, traders stare at screens like it's a verdict, and everyone agrees on the story. The Fed just decided interest rates. That story is comforting. It's simple. It's wrong. Because by the time that sentence appears, interest rates have already moved. Mortgages, car loans, corporate debt, government borrowing. The real rates, the ones that actually control the economy, were decided somewhere else by someone else, long before the cameras turned on. Today we're going to talk about who really decides interest rates, and why pretending it's just a room full of central bankers is becoming dangerously outdated. This matters now, because we're living in a moment where rates are high, debt is enormous, and confidence is fragile. When people misunderstand who's in control, they misunderstand the risks. And when that happens, shocks don't arrive gently. They arrive all at once. Let's rewind. For most people, the Federal Reserve feels like an all-powerful machine. They meet. They vote. Rates go up or down. End of story. But what the Fed actually controls is very narrow. One overnight rate between banks. For reserves. That's it. It doesn't directly set your mortgage. It doesn't directly set bond yields. It doesn't directly set the cost of government debt. What it really does is send a signal. And the system decides whether to listen. To understand who's really in charge, you have to stop thinking about interest rates as a dial and start thinking about them as a price. A price for money over time, and like every other price, it's set in a market. The largest, most liquid, most powerful market on earth. The global bond market. This is where trillions of dollars move every day. Pension funds, insurance companies, sovereign wealth funds, foreign governments, banks, algorithms. Everyone who needs a place to store value safely or move massive sums without breaking the system. They are not voting. They are not debating policy. They are reacting to inflation, to growth, to politics, to debt. When they buy bonds, yields fall. When they sell, yields rise. That yield, especially on U.S. Treasuries, is the real gravity of the financial system. Everything else prices off it. Mortgages don't care what Jerome Powell says. They care what the 10-year Treasury is doing. Corporate loans don't wait for press conferences. They price off market yields. So here's the uncomfortable truth. The Fed follows the market far more than the market follows the Fed. That sounds backwards, but history keeps proving it. Think about 2021. Inflation was accelerating. Bond yields were rising quietly. The market was already saying, this is not transitory. The Fed kept rates near zero, not because the math supported it, but because the story did. Then 2022 arrived. Inflation exploded. Bond markets revolted. Yields surged. Financial conditions tightened violently. Only then did the Fed sprint to catch up. They didn't lead the move. They validated it. That pattern repeats over and over because the Fed has a constraint no one likes to talk about. Credibility. If it pushes rates far above what the bond market can tolerate, things break. If it holds rates far below what inflation demands, confidence breaks. So the Fed walks a narrow path between two forces it doesn't fully control. On one side, inflation expectations. On the other, debt sustainability. And sitting beneath both is math. Here's where it gets uncomfortable. The United States has over $30 trillion in debt. Every percentage point increase in average interest cost translates into hundreds of billions in additional annual expense. That money doesn't appear magically. It has to be borrowed, which means more bonds, which means more supply. And supply matters. Because bond buyers are not obligated to show up. They don't owe the government loyalty. They owe their own balance sheet survival. If inflation stays high, they demand higher yields. If political risk rises, they demand higher yields. If debt explodes faster than growth, they demand higher yields. And this is how markets discipline governments. Quietly, relentlessly, without elections. And here's the irony. The Fed is often blamed for tightening financial conditions. But many of the most painful rate increases happen without the Fed doing anything at all. Yields rise because buyers step back, because auctions get weaker, because foreign demand softens, because trust erodes. The Fed doesn't set that price. It reacts to it, sometimes by hiking, sometimes by cutting, sometimes by pretending everything is under control. Which brings us to the part no one likes saying out loud. Interest rates are not decided by intelligence, or wisdom, or even policy. They're decided by fear. Fear of inflation. Fear of default, fear of dilution, fear of being last in line. Every bond yield is a vote on the future. And lately, those votes have been getting louder. Now zoom out. The U.S. doesn't just borrow for itself. It anchors the global financial system. Dollars are the world's funding currency. Treasuries are the world's collateral. When U.S. rates move, everything moves. Emerging markets, housing, tech valuations, governments halfway across the planet. That's why this question matters. If markets, not central banks, are really in charge, then stability depends on confidence. And confidence is fragile. It can vanish faster than any policy meeting can respond. That's the risk no rate decision can fix. Because once markets start questioning the long-term math, no speech can reassure them. No dot plot can calm them. No carefully worded statement can reverse it. At that point, rates stop being a tool. They become a warning. So the next time you hear someone say, "The Fed decides interest rates," remember what's really happening. A massive decentralized system is constantly repricing the future. The Fed is watching, interpreting, trying not to lose control of the narrative. Sometimes it succeeds. Sometimes it doesn't. And the most dangerous moments aren't when rates rise. They're when everyone realizes who's actually holding the lever and starts wondering what happens if they let go. Because if interest rates are a vote of confidence, the real question isn't who sets them. It's what happens when the market's answer finally changes.